So, good afternoon, everyone. This is Thursday, 14th of December. The time is flying. I remember I even wrote in Hungarian in the Discord server that I remember when it was September and the first time we heard about possibilities of rate cuts by the Fed, and there were people got very excited about that. For some reason, they think the rate cut is very positive, and that's what we saw on the stock market yesterday. That people, for some reason, still thinking that the rate cut is a very positive thing to the stock market, so they just start buying it. But we're going to talk about that and the details as well. Let's start with the macroeconomics, and we're staying with the topic. So the current week, as I predicted, supposed to be neutral in terms of effects on the stock market, the ETF market, and probably somewhat positive for the commodity market, negative for the forex market, and negative for the crypto market. Now, just a reminder that doesn't mean that the market has to go negative or positive or neutral or whatever is here. That's an effect from the macroeconomics, which can drive the market, so can be responsible for the main movements on the market. But don't forget that we have 6 of the main market drivers, and therefore, if the macroeconomics has, for example, a negative effect for some of the market sectors, but, for example, the market events and news has a positive effect, and the market is focusing a little bit more on market news and events, or even on technicals, then we are in a situation when we counterbalance the positive or negative or whatever effect we get from the macroeconomics. So the reason why we do this investigation is to identify the possible effects from each of the market drivers. And when we take a look on each market sectors, we put those effects into points, and then after the points, we can see with the overall points that what is the overall effect, so we can get the conclusion how the market is thinking, what is more important to the market. So it's technicals or market sentiment, psychology, geopolitics, macroeconomics, news and events, whatever we have. We can identify clearly what the market is focusing on, and therefore we can get the conclusion that, well, which participants or what kind of participants of the market is reacting. So therefore we have a very good conclusion what to expect from the moving and from the market. So before somebody understands or misunderstands the effects, especially with the macroeconomics, because that's something really what the market is watching now. Now, just make sure what the idea behind this work, what we are doing here with this live stream on the TOTM Pro level. So currently we have this very interesting week. So first of all, Japanese reported a declining money stock from 2.4% to 2.3%. This is not a major decline, and therefore it doesn't really have a huge effect on the forex market. And if we take a quick look on the chart, we see that it's technically sleeping away. So we got the really large wave to the downside, and since the beginning of 2023, we are while we're declining, we do that with a very small pace. So no surprise here, and as I earlier suggested, we're only watching this data because we want to know what is the point when the money supply in Japan is starting to accelerate, and not even in Japan, because we are following this data from the European Union, from the UK, from the US as well, for exactly the same reason. So technically, what we can say about this data is there is no change, no significant change, and we don't have the trigger point here. But then Tuesday came, and here's the UK claimant count change, the average earnings index, and the unemployment rate, which is a similar magnitude bunch of data than the non-farm payroll in the United States. Here is 3 of these data, almost exactly the same than in the US. And so as we can see that the claimant count change has been revised, but drastically. So the last reported data was 17.8K, and then it has been revised to 8.9K, which is a really big gap. So there was some kind of problem in the calculation, or there was some official and legal change in the numbers to make it sure that they can push it down. And after that, the new data came out as 16.0K, which is a weird situation because this number is actually declining compared to the previously reported data, but it's increasing compared to the revised data. We talked about a couple of times in this situation what to expect from the market. Well, the market will be confused anyway if it gets this data, because there is a part of the market which with this misconcept that they supposed to watching the numbers compared to the expectation, but that's a false idea, because it doesn't really matter. What there is a part when the expectation matters, but in general, when you're investigating the economy, it does not matter what was the expectation and how did we change compared to the expectation, because you are investigating the economy and not the brain of a trader, and therefore you cannot compare to the brain of the trader. You are really wondering what the economic effect of this data. And so if there is a change in economy, you need to compare to the data itself and not the expectation. So in that case, we got a very confused information and a very confused market, probably because they don't know how to react for this data. Because technically, what we can say that this is an increase, a large increase compared to the revised data. Now, don't forget that for this data, the increase is not a positive meaning. So that means that there are more people apply for any kind of unemployment benefit in the United Kingdom, which become harder and harder year by year because the US government tried to reduce the numbers of people who is taking the unemployment benefits. And so we now can say that even if we compare to the revised data, we can say that we have a huge jump to the upside. This is almost doubled the previous revised number. So that's technically a negative meaning in the economy. Therefore, it's negative for the GDP. And because it's negative for the GDP, it's negative for the British pound. But again, the previous number, the original, was 17.8K. We have a very slight decline from that. But at the same time, if we take a look on the chart, the decline itself, it's not so big, it's not so huge. So it's so small decline that it doesn't really change the understanding of the current trend of the unemployment claims, which is very slowly but building up still. But this is a 2.5 year building, and therefore there is no significant change in the data, and this is how we interpret that right now. So no negative effect, no positive effect, but we have a general negative effect for the long term from this data. And then the average earnings index came, which is important because, as you know, if the earnings is increasing, that's inflationary. If the earnings is decreasing, it's deflationary. But at the same time, if we have a very high interest rate environment and we have a declining earnings, that's a very, very bad scenario, because then this means because of the high interest rate environment, people really struggling to get loans out or pay it back. Meanwhile, their salary is declining, so not even the loan itself and the interest rate on the loan is higher, but the income is lower. So there is nothing worse for a normal household to pay back anything technically. So this scenario is not so cool in the UK, and this is what we're experiencing right now, because the previous data was 7.9%. And then it has been revised to 8%, which is only 0.1% increase. I don't think, or I don't believe this is it's part of any kind of manipulation on this number or anything like that. But the new number declined to 7.2%, which is because what I just said is a very, very bad information. Because, we just saw that the Federal Reserve keep the rates on a very high level, and therefore there is a very high chance that the BOE is going to do the same, or probably going to do the same. But meanwhile, we have a declining average earnings, and this is the fourth month of decline, consecutive months. And this will really pressurize the average household in the United Kingdom. So not a negative, not a positive news at all. And because this information is about how to suppress, or how much the UK government is suppressing the UK households. This will have an effect on the UK GDP probably next year. And therefore, if something is negative for GDP, that's negative for the British pound again. So so far, 2 out of 2 data is somewhat negative or absolutely negative for the British pound. And then here comes the UK unemployment rate, which is pretty important and pretty high. Unfortunately, we have previous 4.2% data, and the new data become 4.2% again. So there is no increase, but there is no decline. And that's somewhat worrisome, because that's, if somebody wants to see a healthy economy, it wants to see that the unemployment rate is going down and not going up, or not, while it's going up, it's consolidating. That's the same word. So it's, again, while the data itself is neutral, the long-term effect of this situation with the unemployment rate is technically negative. So what that means for long-term thinkers and for short-term thinkers. Now, if you have a data which is neutral compared to the previous data, that means that the market, the part of the market who is really watching those macroeconomic data, and then after the publication, they are reacting for it, they will not react for that data, because that's obviously neutral. So they don't know whether they're supposed to interpret the data as positive or as negative. So they go back to the previous data and have a decision how to react about it. But for the long term, if you take a look on what effect those information have on the economy itself, that's all negative. So we can expect furthermore negative economic environment in the United Kingdom, according to the numbers we see here. So that's what we got from the United Kingdom. And then at afternoon, the United States came, and we had a core and a non-core CPI, which is the inflation itself. We got the CPI monthly basis and yearly basis as well. So as you can see, the core CPI, which exclude the energy prices and food prices, because it's too volatile, so they figured they need a kind of figure which is somewhat like the Canadian version. Is somewhat median, somewhat flattening out a little bit, so those volatile informations, so they can see a better average CPI number. And that was 0.2% previously, and now we got the 0.3%. Now, it's somewhat understandable. We talked about that earlier, because here is the year-end holiday season, Christmas time, everybody happy, and everybody wants to go to shopping. But therefore, we're going to see some increase in terms of retail sales, and therefore, or supposed to see some increased retail sales, and therefore we see some a little bit higher economic activity at the year end. And this is what it's like. So we have a 0.1% increase in the core CPI, while the monthly CPI also increased with 0.1% from 0.0%. And the yearly CPIs declined from 0.2% to 0.1%. The reason why it can decline, because the yearly CPI compare the inflation to last year at this time. So how was the CPI in December? And therefore, this comparison is actually declining from 2022 December. But the decline is very mild, and even the Fed mentioned yesterday that probably we're not going to get to 2% this year, nor next year or even after, because they are really, really afraid about that they're not going to get the goal, which is a very important information, and I'm going to talk about that in a minute. So technically, this is somewhat positive for the DXY, and because the economy, it seems to be accelerating if the CPI is really mildly increasing a little bit. But yeah, in that term, it's rather a consolidation than an increase. It's increased compared to the previous data, but if you take a look on the bigger picture, we are still consolidating in the last 6 months, and we are still declining in the last 2.5, almost 3 years. So this is a probably we are reaching a point with the CPI, which is a deadline, if we can say, when a turnaround it can be expected, and some of the inflation increase can be expected, but not as much or not as drastical as we experienced before, when there was a 2020 CPI increase. As you can see, that was like crazy high. So this is somewhat positive for the short term to the DXY, but it is still negative for the DXY in the long term. And so we went to Wednesday, and that was a little bit more important day, because the UK GDP is indeed declined from 0.2% positive to 0.3% negative. And here is the catch. So you remember when this whole thing started with the COVID, and then the supply chain and everything started to go down, and there was a very, very negative picture ahead of us about the economy, which turned out really negative, because now we see what that means and what happened actually. And so at this time, we got a couple of data, not only from the UK, but from the US, from the European Union, technically from all around the world almost, that GDPs went to negative 2 to 3 times after each other, which is somewhat definition of recession. And now they are admitting the 2020 recession. They still don't admit the recession afterwards. They will a little bit later, but we gotta be patient about that. So, but since that time, the economy really proved that it's worsening, and it's deteriorating, and it's going down, and it's really, really not better than it was even 3 years ago. And that's a problem, because if in that case the GDP is declining and goes negative again, especially 2 to 3 times, this suggests a really strong recession again. So this is it did not happen in the UK, because in the UK, at least in the UK, they do not deny the recession, and therefore they know exactly that the economy is in a recessionary period right now. But that's just scary looking at how much the UK economy is actually slowing down. So we really don't want to see another data in negative, because if we do, this means that the UK economy is reaching a point when it will be seriously damaging the UK households and also the British pound. So yeah, that's why I said that we probably are at a deadline when we experience some of the deflationary effects, especially from the energy sectors, but nowhere else. And that's like a very usual scenario at the beginning of a recession, even in the US. So it's technically negative for the British pound. And then we got the US core PPI and the US PPI, both of them monthly base. Now, the core PPI did not do anything, which is a little bit scary. So it was 0.0% previously, and the new data becomes 0.0% again. Then that's not a really big news, good news, because there was this drastic drop from 0.4% previously, and it went down all the way down to 0.3%, and all the way down to 0, and now we're staying at 0. Now, I checked out the history of this data, and obviously I'm following for a long time now, but I don't really find so many times when there is 2 consecutive data at 0.0%. So I strongly believe that this data is not the data which is really the core PPI is, but rather probably right before the next release in January, we're going to see some kind of revision, most probably, because I think the data is definitely a little bit positive and not 0.0%. But this is how it came out. So this is a neutral effect for short-term traders, and that is not a positive effect for long-term traders, because a declining PPI suggests a deflationary period when the interest rate is high. That's not gonna show any good. Now, because the reason now it's not that prices are dropping and therefore people can buy more stuff, because the thing is that we turned 180 degrees, because people started to suffer by the inflation previously. They losing the value of their money. They losing the average earnings, etc., etc. So even products are going cheaper. Some of them already not able to buy it. And so the declining of the core PPI is not happening because the declining of the prices, but this is happening because even with the very low amount of supply, the demand is declining drastically, and therefore they need to decline the further decline the supply as well to make sure that this stays or gets into balance later on. And so here is the US PPI, just beautiful showing this picture. So we had this 0.5% in negative, and then we had a revision to 0.4% negative. Not a big revision, but a small correction. And then we just jumped to 0.0%, which means that there is no improvement, but there is no decline further. So technically everything stays the same as it was in last month. So nothing positive right now to the US dollar, and that's a little bit concerning. And then here comes the Federal Reserve. If you go to the Discord server, the Hungarian one, I had a very not very long, but it's fairly long conclusion about what Powell said and what was the decision of the Fed. Now, for the first, I was laughing because a couple of minutes after the Fed meeting, news outlets already started to put the news that, oh my God, the Fed is talking about rate cuts. And I was like sitting at the front of my monitor and then thinking about it. Either I don't watching the same movie what the world is watching it, or I just simply forgot to speak English at all, because I did not hear from Jeremy Powell to speak about rate cuts, while yes, for a couple of questions, he emphasized that Fed members did indeed talk about rate cuts, but not in terms of should we do it, but in terms of if we continue to go on that path, what the Federal Reserve does and how the economy responds to that, there will be the time to talk about the rate cuts, and they trying to prepare the environment, the Fed environment, for talking about rate cuts, but there was no discussion of possible rate cuts whatsoever. And that's what Powell said. And since that, I checked the news again this morning, and I see that, okay, so news outlets get back a little bit now, because now they try to, create sentences in a more careful way that, well, the Fed did not talk about rate cuts, but at the same time signaled possible rate cuts in 2024, which is absolutely fine, because since 1 year we're talking about possible rate cuts in 2024. So it's just so perfect that everything is happening on the way as the Fed communicates since the beginning, and people just, I don't know what the problem with their brain, seriously. So anyway, so they leave the rates at 5.50%. And as I explained to you, they have a projection, but this is not a plan. It's just a projection in case the economy responds on the way it does now, and it continued to do in 2024, which means the economy is continued to slow down. Most probably they still see the possibility of a soft landing, and in case of the soft landing, they could bring down the rates to 4.6%, which would mean, with the very careful steps of the Federal Reserve, 3 rate cuts, probably at the second half of the year. At least that's the first thoughts I have about it. And with 25 basis points on each cut. And so that's the careful way. Now, this will happen only if there is no financial breakdown in the US, or there is no any similar banking breakdown what we experienced in 2008, or even more drastical thing. I don't know, really, that could be whatever, Third World War, I don't know, problems with Joe Biden's health, or no problems with Joe Biden's health. I don't know. That's anything could happen, which is really drastic. And in that case, the soft landing is not. It's no longer possible. Now, I do not say that the soft landing is impossible, but there is one thing, and I'm really, really skeptical. I always been, and I will be, because if you go back to each of recessions starting from the 1930s, Federal Reserve is always talking about soft landing, and it's always explaining its steps with the soft landing possibility and how good we are going to that direction. No recession. Now, at least Jeremy Powell admit there is a high probability of recession, but he is very careful to say that, and he doesn't think it's going to happen. Of course, he cannot say even if he thinks so, because that would be very, very, let's say, undiplomatic. But in that way, so every single time the Fed is communicating a soft landing, but if you determine the meaning of soft landing, it's never happened. So there was never a soft landing in the history of the Federal Reserve. So while it really would be bold to say that it could not happen this time, because this would be like something I would say that we are definitely not going to break a resistance. Now, there's nothing I could say about it. It definitely will not happen. But I still give a very, very low chance to have a soft landing in the United States right now. So I am, just as everybody else, very curious what's going to happen. I'm really interested about the development of the US economy. But based on the numbers, it looks like we will not have a soft landing. Second thing is that what you saw on the stock market right after the rate decision, and especially the press conference, that retail traders started to react on the stock market very positively, because retail traders heard only that, oh my God, rate cut, this is good. But in reality, the rate cut is the worst thing could happen, and it will happen to the stock market. So this is brings a very interesting scenario for us, which I'm going to explain when we take a look on the points and how other market indicators, behaving right now and affecting the market itself. So far, that's the Federal Reserve funds rate, which is technically very, very, it's supposed to be more positive, because as long as the rate cuts does not happen, that's technically the only reason why it's good for the stock market is because the rate cuts will be very bad. But that's all. So it's nothing like there is no higher sales with the companies, no better company performances at all. So nothing improved because of the rate hikes. In fact, higher rates just squeezing the money out of the company's pockets. So it's not good at all. High interest rates is not good at all, and that's what investors already understanding. That's why they're leaving the stock market. But retail traders really don't just yet. Now, just one little side note from me. Imagine you are an investor, but not like, like a really investor, like Warren Buffett or something like that. And you have an investment in a company, and you know exactly that bad times are coming. So you got to get out of this investment immediately. But you're experiencing that, so you're not going to buy more and more stocks. That means that you're not going to buy. You are already planning to get out. But you experience that the retail community is pushing up and up and up further your stock price. So yeah, if I would be Warren Buffett in that case, because I am not, because I got out of my investments way earlier. But if I would be now Warren Buffett, I would not press the sell button just yet until I don't see that the retail traders are really losing their power and they are unable to get everything out, which is a very risky game, because what if somebody else, another very good investor, will indeed push the sell button and I will be late? Because that's just, a little correction in terms of on what price I will sell my stocks. So I believe the majority of investors are, I see that they don't buy anymore. In fact, there's some of them already sold. We saw the downward waves earlier on the stock market. So they are selling, but there is not much selling yet because they're using the retail traders to push as high the stock prices as possible, because then they want to get out. So this is always what I explain to you all the time, that you need to be very, very cautious when you go buy anything right now. I'm not talking about you bought something and still holding it, but I'm talking about if you are planning to buy something. Because obviously there is two kind of people: who is planning to buy something but fully aware of the danger, and it will get out as soon as the danger occurs. But there is another one who is planning to buy for long term, because oh my god, this is the best bull rally ever on earth, and planning to hold for a long time. Therefore, when Warren Buffett and his friends will push the red button, he will not sell it, but he will keep just holding it, because will not believe that we are really going down. If they don't believe to us yet that we say that there is no more buying, and they are really watching the moment they could sell all of them, they will also not believe to us when we're gonna say that, hey, everybody sold it, so you should get out now, really, because that's not even going up, it's just going down. And he will not believe, and he will not sell it, and then he will lose it. So you see the difference between a really cautious trader or investor and a not very much clever one. So that's the difference between two. So whoever knows what it's doing and what the dangers, so buy into that something and don't plan to hold for long term, but when the danger signal is there, getting out. And if we go forward to the upside after that, then it can get back again. But if there is a danger signal again, it gets out again. So just taking the profit. So be a clever trader. Now, there are risky scenarios and less risky scenarios. We saw both of the situations, especially with larger ETFs this year. We're going to take a look on the charts, what that means exactly. But let's finish the macro very quickly. The New Zealand GDP came, it was 0.9% previously, then it has been revised to 0.5%, which is a negative effect in its own. And then we got the -3% again. So this is the second GDP in one day that it's going into negative, which is that's not a good signal, by the way. So two of the countries reporting negative GDP. The negative GDP means that the country does not create money at the moment. It's spending money. It's a deficit situation right now, and that's not good. So if we see that in one country, you could see that, okay, that might be a local problem in the UK because we know that Brexit after effects, blah, blah, blah. But New Zealand has nothing to do with the UK Brexit. So just an alarming signal that the economic slowdown is start to pick up the pace. And that's not a good thing. And that's why I think that we really get out of a line, and if we do, there will be no possibility of soft landing, not only for the US but for any country around the world. So we need to be very cautious about that. So, and then Thursday, which is today, we got the Australian inflation expectation. It declined from 4.9% to 4.5%. But this decline is negative for the Australian dollar, by the way. But it's still holding its place a little bit lower than the previous lows. But it's slowing down in decline. So we got the big decline, and now we are slowing down with the decline. And I believe that this will over months, so it's gonna take years, but it's gonna go up again. And Australians will see the pressure as well. So even if, for example, and that I think this is exactly the way what the United States and probably almost every single country will do. Maybe the European Union is the only one will not do that way. Not 100% sure on that. So what they're going to do is, because the CPI is declined, they're going to reach a point in a few months when they decide to cut rates. But this rate cut will not go back to the level it was before. And because of the rate cut, the inflation going to come back again, which therefore they're going to start raising interest rates again for another period. So that's what I think is going to happen in the next 2 to 3 years. This is how long it's going to play down. So the Australian unemployment change came in. It was 55k, and then it has been revised down to 42.7k. But the new data is 61.5k. Now, this is somewhat understandable. I was writing about that in my analysis. If you are a pro or advanced member, or you just subscriber in the Hungarian channel for macro analysis videos, then you know exactly what did I write about that. So we got this activity at the end of the year. Finally we see that in one country at least. I'm quite happy with that. So there is some activity. You see that on the employment, but it cannot go any higher. It couldn't. It's just really stopped here. So technically, that's a short-term positive news for the Australian dollar. But in long term, there's no technical changes in the employment sector. But here is another problem. While we got some workers picked up at the end of the year, the unemployment rate was rising because the previous figure was 3.7%. This has been revised to 3.8%, and now the new data is 3.9%. So the unemployment rate in Australia is increasing, and it's accelerating to increase. So that's what Jeremy Powell tried to tell us as well, that if this happens in the United States, then the soft landing is probably not going to happen, and they need to change the course and immediately cut rates, because this not only means recession, but it's also extremely very bad for American households and whatever country you are in. It is bad. So that's a very negative news for the Australian dollar. And then we got the usual 1.75% interest rates from the S&P, which is no change. There's no, rather significant effect of the Swiss franc, but at the same time, the amount of the highest of the rate is not so much. So it's not so damaging to the Swiss community right now, but it's still not for long term. It's not a positive thing. But as you can see, that 1.75% is way lower than any other For example, the previous UK 5.25%, that's really a high interest rate, you could say. But we haven't got that data yet, or well, as I'm recording this live stream, we did, but I just had no time to check out, so we're going to talk about that later on. So as you can see, we see very mixed informations. For example, a positive news for Australia, but right after that, a negative news for Australia. There's a neutral news for the US, then a negative news for the US, but there is a short-term good news for the US. So it's a very mixed week, and that's just exactly what I expected from this week. A big macroeconomic mess, what we see here, and exactly that's why I had the neutral prediction as an effect. But it is positive for the commodities, because if the economy is uncertain, but its direction is to the downside, that can be only a positive effect for the commodities, but it's negative for the forex and negative for the crypto as well. For the crypto, that's a different story. So that's the macroeconomics. And if we take a look at the quick points, there is no change in terms of the ETFs because it's neutral, obviously. And you will see no change in points in the stock market because it's neutral, obviously. So everything staying as the same as it was on Monday. But the commodity market is experiencing a neutral effect. This is somewhat positive. I mean, the overall effect, what we're experiencing here, is positive for the commodity. But don't forget that commodities need a really, really trigger point in the macroeconomics, and then it can move with this point into either direction. But because that didn't happen just yet, because there would be a rate cut or whatever, so the point is staying at the same level that it was on Monday. And if you take a look on the forex market, there is a little improvement on the points of macroeconomics, because while it is negative for basically, let's say an example, this macroeconomic environment is negative to the euro, and so far the data what we got, there's not much euro connected data what we got in this week, but so far is, let's say, it's negative. But at the same time, if there is any news coming out and it's also negative to the DXY, now that counterbalances the negative effect for the euro from the macroeconomics, and therefore the overall effect will be positive on the euro. And this is why we got some point, increase in that matter. It's still in a negative territory. It's a very negative territory, but the point is increasing. So we are well below zero, but some improvement in terms of point because of the DXY. So that's how it should be understood. And if we take a look on the crypto market, the macroeconomics is also, for the same reason, is improving, but is still in negative. So it's a minus 10 point right now. It was minus 11 previously. But because the macroeconomic area has a very negative effects to the DXY as well, and because the DXY is the dominant currency all around the world, even on crypto market is the dominant currency, because most of the stable coins are connected to the DXY and not to other currencies. Now, I know there are stable coins with tied to other currencies, but they are not so popular at the moment. But probably will be, but not now at the moment. So this is why the point is improving a little bit, but it's still in negative, a negative minus 10 point. So if we there is no change in the geopolitical field, and there is no change in the corporate earnings field, obviously, because we're waiting for Q4, which is going to get later. And therefore, none of the numbers changed in the market sectors with them. But there is a couple of interesting news I wanted to show you. Not about commodities, they are staying the same. Not about crypto, staying the same positive. But a few information on the ETFs and stock markets. For example, there is another probable coronavirus impact in China. And how did that fold out in 2020? Because that's what we got, 2020, the oh my god, coronavirus, etc., etc. And then we went back and that's when Europe started to panicking after that. So they started to evacuate things and then close down things and etc etc. And currently there are news from China that something is about to happen. And I just wanted to remind everybody that how did governments are reacting to a possible outbreak of a coronavirus. Now, if there is another virus, because we cannot prove that it is corona again, but if this is corona, that governments might have a little bit softer plan, to fight against. But if it's not corona, I am 100% sure that they're going to do this exactly the same what they did last time. They're going to close down everything, close down the borders, and they completely cut the supply chain once again. This is not a bad news just yet. And I just wanted to raise your attention. Just think about it. If you hear about, you better share with your community. Let's talk about it, because it might be important, might be not, but it could be a big problem, even on the markets as well, because we know exactly what that supply chain cut means. So just be aware, because once again, I just said what Jeremy Powell said. Soft landing is possible. I don't think it is, but he thinks, or at least this is what he communicates, because every single Fed official communicates that since in the last 100 years. But they never done it. And the reason why they never done it, because there was always something always came, and always disrupted this dream world of soft landing. And so just keep that in mind, because if you got a news, maybe in January, February, March, April, May, whenever, that the US is shutting down everything because China is shutting down everything because there is another virus again and everybody's in panic. It doesn't matter whether people believe this is a virus or not. It doesn't matter. It doesn't matter this is a virus made by human, to human, by love. It doesn't matter. The only matters for us is how this will impact the market, because that's why what we are analyzing now. And so just wanted to open your eyes that why we are believing that soft landing is coming and blah blah blah. Things are unfolding in the background for more serious problems, which could cancel soft landing, to say the least. So the European Central Bank is focusing on shrinking balance sheet as the market bets on rate cuts. Very similar situation what we experienced here, not here, but in the US. Because remember, before the rate decision, what just been yesterday, we heard those news as well that, oh my God, the Fed is considering rate cuts, and no, we are waiting because maybe the rate cut is coming right now. That's what they're doing now against the European Central Bank as well. I don't like Christine Lagarde. I'm sorry. And if you happens to watch this video for some reason, I really do apologize about that. You're just not my type and favorite and technically anything. But she did not lie about it, what they are doing. And she never mentioned with a single word that the central bank, the European Central Bank, would consider cutting rates at this time. But they also emphasized the same what Jeremy Powell did with the Federal Reserve, that if there is any disruption in the economy, what we just talked about, yes, the rate cut could happen, but it's not a planned rate cut. So just wanted to show you that how the news is talking bullshit all the time. I mean, all the time. But here is something, it's not bullshit. And this is that you maybe heard about HSBC. If you live in the UK, then 100% you know what we are talking about. HSBC is one of the largest bank lived ever on earth. And they are not stupid, as you know. And what they're saying is that bonds are back as markets enter a new paradigm, says the asset management of HSBC. if this bank says the bonds are back, that means that the bank started to bet on bonds. Just so you know, because the bond market is an important thing, especially at this time, and that's a very good, support of the rising bond market. Just wanted to let you know. That's important, I think, which will be or is affecting the forex market as well. Both of them, the European bullshit news and the non-bullshit US news. But at the same time, I just wanted to raise your attention. So the World Bank is warning that higher interest rates mean difficult choice faced between servicing debt and spending on public services. So technically, poor countries, governments, debt costs to hit crisis level. And it's not even true for the poor countries. As you know, the United States is really struggling with the amount of debt it has. And while it has the solution to fix it, the solution itself could cause the problem. And so, but in poor countries, they don't even have a solution. That's called global recession. You can fight against it. You can come up with any kind of news, any headlines, any government official speaks, anything. This called global recession. And that's what we are in right now. And they will admit very soon, believe me. So just, again, that's not a very positive news. So if we take a look around how the news are affecting the markets right now, the ETF and index market is staying at the same level. There is no change in points. So we don't have to worry about that this is driving the market right now. But the commodity market is really started to watch the news, because commodity market is a long-term market, not a short-term market. It's for long-term traders and investors, not for short-term traders. And therefore, whatever is happening and affecting other markets for long-term, the commodity market will start to react for that, because that's for long-term, obviously. And that is a positive point increase in the commodity market. While the forex market is experiencing a huge point back on news, and that's because the news not only suggesting any kind of possible rate cuts in the United States in 2024, since this morning, because yesterday they talked completely different things, but it's also suggesting to banks that in case the market is really preparing for that, at the first time it will be very negative for the United States dollar. And whatever is negative for the United States dollar, it will be positive for other currencies, at least against the United States dollar. And so that's a positive effect. Not only that, but it's a hugely positive effect. From -6 point, we're increasing to -1 point. Now, this is still negative, but increasing a lot. Just so you know, keep that in mind. The stock market is technically unchanged in points, and that's because, there is a counterbalance. The news itself, for whom the news is positive and for whom is negative. That's the question. It's positive for the not too clever retail traders. I just had a talking with one of my colleague and very good friend one of the day. We was laughing on the word retail traders, because technically retail traders are not all of them stupid. In fact, we are retail traders as well, and if we get the opportunities, we go with the flow. But there is the stupid side of the retail traders, and we found a new word for that, and that's called the retard traders. So I think this is a perfect name of them. So retard traders taking this news environment positive, while investors are interpreting the current situation as negative. And therefore, it's a counterbalance, because meanwhile it's negative for them, they still did not push the red button, and I'm going to show you why they did not push it. Okay, so we go forward. The crypto market is unchanged in terms of the market news and events. As you can see, it is a very positive news environment for the crypto, which is very important, because this is one, if not currently the only one, major driver of the market sentiment. in the crypto, and therefore it's responsible for a huge percentage for the market movement. So it's an extremely positive environment for the crypto right now. So if we talked about news, then let's talk about the sentiment. I don't have to be too long on that, as you can see, because investors are out of the pictures. This is like when you put your children with the neighbor's children into one room and just let them play for a couple of hours. There will be a disaster, but it will be very loud. That's what the market is doing right now. It's in a euphoria. That's the very usual euphoria. That's when go crazy, go buy everything, while the big guys are just sitting on the sideline and laughing because, okay, that just push it higher. I don't give a fuck, but I'm gonna press this button when everybody is pressing it. You're gonna suck because I'm gonna get all your money out. So that's what retard traders will not realize. Why you as a clever retail traders, you are going to realize that perfectly. But until that point, the sentiment is definitely improving on the ETF and the stock market. And for some of the parts of the ETFs, and I'm going to show you the index charts later on the second half of the live stream. So some of the parts is not too positive, but some like mainly the larger ETFs and indexes are definitely positive. Interestingly, large cap stocks are not as much positive as small cap stocks. So this will create a very interesting situation, but I'm going to show you that later on. So this is a very positive environment for the ETFs and the stock market. And as you can see, if we take a look on the points, we got a huge increase from negative to positive 5. And that's a really, really good improvement in terms of the sentiment. And if we take a look on the stock market, we also got we also got a really, really big improvement. It's not as high as the ETF market because now everybody's hyped because of the NASDAQ, but not because of the Tesla. That's the difference. So it is positive, but not as positive. But the magnitude of the improvement is almost the same on the stock market as well. So if we go forward in the market sentiment, as you can see, commodity market is reacting very, very on a very mixed way. The essential foods are declining in terms of market sentiment, and that's because this is clear deflationary pressure on those essential items, and therefore, they're just keep realizing profits on that what they made profit previously. But non-essential foods are really, really increasing in terms of sentiment. It is in the neutral territory right now, so we cannot say that they are in bull trend and there is a hype and etc. But at least in the short term, they are reacting positively. That usually happens when the essential foods are going down in terms of sentiment, then non-essential foods are usually going up. It's like coffee and cocoa and things like that. So the energy is completely consolidating in terms of sentiment. No surprise here. We talked about a lot, but precious metals, now they are booming again. And that was the strange yesterday when I was watching the market, how the market is reacting. And I know that the retard traders are reacting on the ETF and index market positively, but the non-retard traders and investors are actually reacting extremely positively on silver and gold. It's an interesting situation. So we're going to take a look on the chart, definitely. But it's a big improvement. But therefore, because precious metals are going up, industrial metals are going up as well a little bit. But again, this happened once, and I warned you that probably this is a short-term reaction in terms of the industrial metals because there is no improved economy behind that. So as soon as there is a correction comes for the precious metals, then there will be a larger correction, most probably for the industrial metals. So while we can understand this improving sentiment longer term on precious metals, we should interpret that the same for shorter term for industrial metals. And the livestock is improving somewhat, not too much, is in negative territory, but probably because of the fairly good mood on the commodity market, there is an improvement over there as well. So therefore, overall, that's an improvement in terms of sentiment. And now, I don't care what the market thinks. I'm not manipulating this number. If it's improving, I'm gonna improve on the points as well. And now it's in positive territory again, with positive 2 points. Which is 5-point increase. That's pretty much good because we're not usually increasing or improving that much. That happens once and we stayed in positive for a long time, but let's see that maybe this is the trigger for the commodity market. I don't see that just yet. So that was the commodity sentiment, and I don't need to over-explain the Forex market sentiment in terms of banks. So they dumped the US dollar and they try to improve everything. There are lessly good improvements, for example, the Swiss franc, but we don't know exactly why because we're following the chart. So I explained that 100 million times. But there are very interesting improvements. I would like to highlight especially 3 of them. One is the Japanese yen, the other one is the New Zealand dollar, and the third one is the Australian dollar. Now, when we will see the charts, I want you to remember for this improving sentiment, because that will be very important when we see what those charts are doing right now. But in terms of points, we're going to get a improving point. As you can see, from -5, we are jumping up to 3, which is the highest point since we are doing this chart. That's a highlight, and I'm going to tell you why it's a highlight when we're making the overall points, okay? So just remember for that, this is the most positive sentiment in the Forex market since 18th of September. It's almost 3, 4, 5 months. So, wow, that's a wow. So, okay, let's see the crypto market sentiment right now. As we can see, a little bit improving, not with the pace it did before, but it's still improving, and I think this is the proof what I told you weeks before, that now it looks like a very stable market. It is a very stable market, and I just love to see how stable the crypto market is. I hope it's gonna be like this for a long time. I don't know that exactly, which is a little bit concerning, because we got to 8 points last time or previously, and then after that we got oh no, sorry, that wasn't 8, that was 17 points, and then we went down to 16 points, and then we went up to 17 points again. But my problem is that we was not able to increase the points over 19, so we are still in 17, and that's my problem. It is highly possible that we're going to continue the slowly growing, but the crypto market sentiment is not really slowly growing thing. This is a fast growing thing. Usually you see those very volatile changes here. Sometimes it's slowing down, yes, but when it's changing big. And now it didn't change big. So probably we're going to facing for some more problems at very certain zones and resistances. But we're going to take a look on a couple of charts, what that means exactly. And I'm glad you guys asked a couple of crypto assets today, because we're going to take a look on the charts, definitely. So, but before we do that, so this is the point for sentiment in the crypto market. And now let's see the technicals. So in terms of the crypto, that was the last one now. Let's see how is the crypto balance right now. So we have a slight increase on the crypto market. We don't get the previous high in terms of the this is the total market cap. As you see, the volume is stable and large. It's not declining, which is a pretty good news. But I hope that this steam is not going to cool down, because unfortunately the momentum doesn't change. And the problem why is that because we can see clearly from this picture, as you can see, the stock MTM is also declining slightly, but it's still above the 40 line. So from this overall picture, we can see what is actually happening. What is happening, that the crypto market has really found a resistance here. That means lots of people started to take the profit out from crypto to fiat currency. And there is a fairly same amount of people at the same time that putting in the fiat currency to crypto market. So they are like really well balanced on a very large volume. That's what we are seeing now. So which side is going to win? That's a good question, but actually that's a very good environment for breaking a resistance to the upside. That's usually, I mean, a very good fundamental environment that we really will do it or not. We will see that. But for that, I think this is why for the longer term, even if the price is a smaller correction on the altcoins, even it would be better for the altcoins if we start to see some rise on the total market cap and the Bitcoin as well, because we need more money supply, if I may say on that way. So that's the balance of the crypto, which that's stable. It's on a very high level. It could accelerate to the upside, and I don't see the sign why we would drop. Obviously, I cannot calculate with the unexpected events that anytime it can come, but now it's that I don't see the signals of that. If we take a look on the volume, I am very happy because we actually closed the cycle above, with the average at least, above the green line, and that's since, I don't know, that happens. I don't. This chart is not long enough to show you, but that happened. I don't know. First time in 3 years, maybe 2.5 years, something like that. I'm so happy to see that. That means that the life is coming back to crypto market. And yes, the regulations needed for that, because probably now we see other participants coming to the crypto market, not only the crypto fan lovers only, which are fine and we love them, but also now more experienced traders are starting to enter the field. And that's at least this is, I believe, or I hope, because if yes, they're gonna stay here for making profit and not go away and not screaming and crying when something is dropping on the 1 minute chart. So that's, I think it's going to stabilize somewhat the market and the trends, stabilizing the trends. So this is a this is a high point, definitely. We just met with a very serious resistant line, that's for sure. But we also have the power still, and we also have the volume for that still, at least at this moment. And therefore, if we take a look on the chart, you see exactly what was that resistance, what we met with. So I am really, I don't have any prediction at the moment whether we, how much chance we got to break to the upside or falling back to the downside. If you're breaking, the next resistance is 1.80, and I see a good chance in case of the breaking. I see a good chance to get that level, but be careful with those trials. Those tried as well, but it got rejected. So this is a higher high, what we need to be very careful underneath. But after that, I think the total market cap has a green light to the next resistant level if there is no major disruption. So technically, we must have somewhat neutral in technical terms, because we met with the resistance, we got the power, but we don't have the proof that we're going to break it, but we also don't have the proof to decline. That's a complete neutral change in the point, but in positive territory, because the volume is there and the market wants to buy. So therefore we have consolidation in positive territory, which I'm very happy to see that right now. And I'm so happy to explain to you what the point means exactly, because now you can understand what that means exactly and why we're going to get the overall point. But before we go to the overall point, let's see the technicals on the Forex market. As you can see, the DXY not only made already two fairly large candle to the downside, it has a low below level, still above the 101, but this is obviously the signal. We got rejected by the scale EMAs, therefore we are making another leg to the downside. It will continue probably in the next few days. But if you take a look on the euro is not as positive as the DXY negative, because DXY already has the low below. But the euro is very far away from the higher high. So that means that this is still weak. It's just reacting to the DXY, but it's a weak asset. Not like the Japanese yen. It's nothing like the Japanese yen. The Japanese yen is really strong right now, but we know exactly why, because the sentiment was so hungry to see, even the BOG was so hungry to see that the Japanese yen is going to the upside, and they're using these opportunities, this DXY decline, for full power. So they've full power. So that's a very positive balance on the Japanese yen right now. Lessly positive for the BXY, so the British pound. As you can see, it's just, somewhat in the consolidation zone, and it's staying there. Probably going to keep rising, because in case if the DXY is keep declining, that's inevitable. It doesn't matter what kind of negative views the British pound will get now, even the negative GDP, it doesn't matter. If the DXY declines with power, this will rise with less power. And that's the difference. Because if the GDP would be like 0 or 0.1% in the UK, then this would be a same magnitude rise what we're experiencing here on the Japanese yen. So the game so far in strength is at the Japanese yen. But if I go here, that's same, or was almost the same than the British pound. But there is a very, very easily identified and strong zone between 61.82 and 62.18. And if we're breaking that and the DXY keeps declining, we know exactly where is the next level. So this balance is keeping somewhat neutral to positive, but the breakouts, the breakthroughs always bring some volume. And therefore, it's really worth watching. It's not strong now, but it could be strong later, just as the Japanese yen. If you take a look at the Canadian dollar, the Canadian dollar is just keeping itself within the consolidation. Could be a rising could be expected if the DXY is weak, but it is a very similar situation than we experienced on the euro. It may be a little bit better than the euro, but it's still supposed. It meant to be weak. And if you're searching for the perfect environment for momentum balance, the Canadian dollar is not that. The Swiss franc is trying to. Later on, you will see on the technical charts why it's just trying and not doing it. And I think they're not gonna let this go too high. So probably gonna keep rejected. Even if we go a little bit higher, it will stay. It will be a risky asset from that point of view, but we're going to see the technical charts. And here is a very similar one than the New Zealand dollar. This is the Australian dollar. And this is showing really strength, very similarly than the Japanese yen. So there's three major currencies are strong in increase, and that's the Japanese yen, the New Zealand dollar, and the Australian dollar. And the DXY is very weak, so that's a so perfect environment on crypto. Crypto. I'm talking stupid on the forex market. So if you want to use it, the forex market, I think that's right now is a very good moment. In the next couple of days, if the DXY keeps declining, this could be a very good time to make money on the stock market. So that means that some of them neutral, some of them very positive, one of them is negative. And if we go through the points, the technical points on the forex market, as you can see, this is way enough to increase the numbers, because most of them rather neutral or negative together with the DXY right now. It is still a negative point overall, but the improvement in dimension 3 is so momentumful, so powerful, that it's actually jumped it almost positive. Now, just a little bit we need for that to going to positive. Probably if we do that for a week, then it's going to happen. And here is the stock market. Now, the stock market is rising like hell. As you can see, this is the S&P 500. It's going to the upside, while obviously because it's going to the upside, the VIX is unable to rise at all. But because the VIX unable to rise at all, that's the signal that there is no major put contracts on the options market. So the options balance is falling back to the calls, but not to the level it would be very scary. So there is not too much call contracts, but there are the call contracts are representing the majority of the options trading right now, and therefore the balance is positive from the options market. So it's positively affecting the stock market, especially the S&P 500. While the balance itself, as you can see, that the RSI is way above the 70 line, while the MACD is trying to turning back. I'm a little bit skeptical about that, to be honest, but it could happen very easily. But if we go down to the stock, MTM, as you can see, we are turning back up way bit, so we couldn't cross the 40 line. We're turning back to acceleration to the upside. This whole picture, and oh yeah, sorry, and by the way, the S&P 500 is, I think it's the only one managed to increase the volume. The only one, because even the Nasdaq is falling, but I'm going to show you that later. So what that means, that the options market is helping the S&P 500, but in average, but this is why the volume could or managed to go to the upside a little bit. Retard traders are all in right now, whatever you can imagine. And this is why we have a very, very overstretched market. So it's absolute out of reality, but that's not the point I want to say. But the point I want to say that imagine you have a plastic bag and start to stretching it, and we probably at the, you know, the last moments when it's still stretching it, the last stretch is just happening, and that will be one point when this plastic bag gonna be cut, and yeah, the rest, you know. So if that means that if you have a good momentum watching strategy on the S&P 500 or whatever is going up because of this retard hype, then you're probably good to go with it, because as long as they provide some kind of momentum to the upside and you're not in a no-go zone, etc., you know, in short term with small trades, this could provide some of the very good opportunities, because at least now we can 100% prove what's behind fundamentally the rally. And that's the, you know, the misunderstanding of Jeremy Powell. Mainly that's the reason of the rally. Yeah, which is, I think, in 2023, I mean, since 2020, we should not be surprised about anything. I am not surprised about flying cows or anything like that, because that's just, you know, the new world order. We are living nonsense, so let's live it nonsense. But if you do that, and again, let me highlight you for that, if you do that, be very careful, be very vigilant for dangers, and if you got a danger, just get out. You can get in again if it turns out it still wants to go to the upside, but the economic fundamental is not supporting that move at all. In fact, it's supporting a crash, and that's why sooner or later it's gonna come, especially when the rate cuts are going to happen. But until then, you know, if the retard trade decides to do that, and if you're not in a no-go zone, because we're making new highs now, you gotta go with it. So that's the meaning of the balance. And if you, by the way, if you see that, we just approaching, oh yeah, it's already, we arrived to the first possible scenario target here. So I'm really wondering whether we're gonna get rejected by this zone, or we're breaking the zone and we're going to the second possible target. I still give less chance to get here, and I still think that this is a rejection zone. If we break it to the upside, that's definitely momentum, and gotta use it to the upside with small trades, with short trades. But if we get a rejection, then there is a very high chance that that was the top. I'm not saying that was the top, but there is a very high chance that that was the top. And probably we will see the price only falling in the next 2 years. Most probably. But that's, for that, we need, first of all, we need a rejection from here or from here. And then we need a new price building low below, which probably going to be maybe that zone if we don't make a correction now. If we're making a correction now and trying to break again, then it will be that one. So if we're making a lower low and a lower high, that's a proof that we changed this whole structure again, and then we continue to do this one, this big one, what we saw here. It might be going to be bigger, it might be going to be smaller, it might be just reaching to that point, might be lower. I don't want to predict that right now. There's tons of prediction online, so I don't want to participate in that until we're not doing it. I'm not predicting it, but right now I'm predicting this one, and that could be easily a rejection zone. So the S&P 500 could get the momentum to the upside. By the way, the Nasdaq is better than the S&P 500, just so you know. But that's the technicals. And again, because I'm not going to bending the numbers. I'm not gonna put on the way I don't want to see. I do increase the numbers drastically because that's what the technical shows right now, and we have to increase the numbers. So that's why we're gonna get a very accurate number with the overall point, which is gonna show us probably what to do. That's the ETF market, and if you see the stock market, we got also the very largely improved technical numbers, but the stock market is just a little bit different because because everybody says now, oh my God, look at Apple. Okay, I do. Oh my God, look at, I don't know, Nvidia. Okay, I do. It's not very good, but okay, I do. But I can show you also very big companies. And it's called Walmart, which is bigger than, I don't know, Nvidia. I can show you PayPal. I can show you tons of stocks. They are moving in a bear trend right now, or at the very bottom, and still completely unable to do anything to the upside. So the stock market is very mixed. It's different than the ETF market. Just keep that in mind. So that's why it's a little bit increasing with smaller points. So that's the point of technicals, and now let's see the overall points. Let me start with the ETF market if we were here. So the overall point is jumping pretty high. That's minus 28 points. It's also still minus. Now, if you're wondering why the hell the point is in minus when I see the Nasdaq is very high, the S&P 5 is very high, the US 30 is making new higher highs, and things like that. Yeah, but these are not the only indexes and ETFs. And if you take a look on a few more of them, which I'm going to show you, and if you check out the whole ETF markets, they are almost all of them reacting positively, but the majority is in bear trend, not in bull trend. So yes, it's fun to see the S&P 500 to the upside and the Nasdaq, but this point is measuring not the Nasdaq or not the S&P 500. This point is measuring the whole ETF and index market. And that's still, the majority is negative. Just take a look on the Chinese, for example. So yeah, before somebody misunderstand why this point is still negative, is that's the reason. It is improving, and since those things are going to the upside, this point is going to the upside. So there is no cheating here, but it's negative because the rest of the market is in bear trend. Not a coincidence. So what we need to know about the market right now is that it's mainly bullish on the larger ETFs, and because everybody's watching that, and the market is really overheated by the retards. The sensitivity, so the strength, which gives the strength in the current trend to ETFs mainly, is that the sentiment, the news, and the technicals. But the surprise possibility, so where the surprise could come, and we need to keep one of our eyes on them, is the macroeconomics, the geopolitics, and the news. Those are the market drivers can cause a surprise for the trend, and so keep an eye on that. So now the risky sector is the non-safe haven sectors, because safe haven sectors now rising together with the non-safe havens. But when the trouble comes, the non-safe haven gonna keep rising. The safe haven gonna keep rising, while the non-safe haven sectors are gonna decline. So that's why they are these risky sectors. Because if somebody is not watching it and not reacting in time, they're gonna stick in the position, which is bad. So the main risk on the ETF index market right now is the retard euphoria, what we talked about. And the fact that investors are fleeing to safe haven assets right now. Now, when you see that the stock market is rising, but safe haven is rising as well, it's never a good thing. So don't believe that's going to be a good thing for long term. Again, so yeah, that's the index ETF and index market overall point, and similar sector. So the stock market, as you can see, the overall point is increasing. That's at minus 40 points right now. Again, the majority of stocks are in bear trend, not bull trend. So that's why it's a negative point, but it's a huge improvement compared to the previous one. And now let me just tell you one conclusion, because now we see it together. The ETF market overall point is jumping hugely. The stock market overall point is jumping hugely. And we know exactly that on both of them, the main strength which is coming is sentiment. Now, if this thing is happening, meanwhile, the safe haven sectors are rising as well, that means only one thing. We have arrived to the official pre-recessionary euphoria led by retards, and I still think it's going to end not very well. But there is a good news with that, and there is a bad news with that. The good news is that at least we're going to get momentum to the upside. So as long as we have the momentum, because they're now going to accelerate to the upside, that's for sure. So as long as we have the momentum, be a clever trader and use the opportunity to the upside as long as you have the momentum. But at the same time, be 100% aware of the danger. And when you see the danger, get out, because the fall that's going to follow this retard euphoria is going to be way larger than the increase what you're experiencing now. And that's the short party time, which I want you to keep making money out of it, because that's how you're going to provide the money in your pocket every single time. So that's what you got to focusing on. So the direction is very mixed. The direction stated is uncertainty or uncertain volatility. That's what we are experiencing right now with this retard hype, and the sensitivity, as I told you, is coming from sentiment and technicals. But the sentiment, if the sentiment is driving the market without any economic related driver, that's always a very risky situation. That's now the most risky situation, in fact, because the surprise in that matter can come from the macroeconomics, geopolitics, and obviously the communication of both from the news. So that's what the market is. The risky sector is the large cap stocks, because those are way calmer than the small cap stocks right now. So there's no more investors, and be very careful with that. The main risk on the stock market is the retard euphoria. I just misspelled, I think, and the fact that the market needs a trigger, like a geopolitical or financial event, something like that. And I misspelled that one as well, so sorry about that. So yes, that's how the stock market is developing right now. The commodity market, is interesting. Is started to rise again. So we are rising to 34 points right now, which is a very, very impressive increase. Now, a question of mine is that whether we are really turning around, or is just part of the downtrend and we are in a correction. And the question I'm raising is because if it's part of the downtrend and that's just a correction in the downtrend, then this is the top of it. And if I would, just because of this point, start buying it, I could make the mistake that I'm start buying it when it's already preparing to go down. But if it's really a turnaround, I am better to wait a little bit more, just one more or two more proof points that yes, the commodity market is indeed turning to bull trend. Because what we need to know about the market that is very bullish, but it's look like it's turning to bull trend, and then usually always cheating us. The momentum is somewhat accelerating in the market, and the sensitivity is macro and geopolitics. So the market is going to the direction where the macro and the geopolitics are directing. Now, this called a stable market. You see the difference between the stocks and the commodities. The stocks driven by retards, commodities driven by economy. That's something I really like it, by the way. But therefore the surprise obviously could come from the technicals and the sentiment. If there is something that the market is misinterpret or misunderstand, Yeah, that could cause problems, corrections, trend changes, things like that. Now, the risky sector in the commodity market is the non-essentials. Is that non-essential foods like cocoa, coffee, things like that, which is non-essentials, because they go together to the upside with the essentials. But when the correction comes, essentials could continue to go to the upside, while those non-essentials probably going to drop back to the level where they've been. And industrial metals are non-essentials right now because they don't have demand, and therefore they're just rising together with the safe havens, and that's a danger. So what that means to a trader? Oh, that means I should not trade in, for example, industrial metals? No, I just gave you the perfect recipe how to trade them. Because that's why you can plan on industrial metals, for example, if they go to the upside for short term, but you can maybe plan on essentials and safe havens for a little bit longer term. Yeah, you see, that's why I'm doing that. That's why I'm saying that, to give you the read how to use the market. It's I always trying to communicate with. So the main risk on this market sector is further slowing economy. And the reason why, because the energy sector will slow down the economy, and that's called energy deflation. And for food and energy market, that's going to be very, very negative. So that's why non-essential foods could crash, even though they're going to gather up to the essentials right now. Or energy could crash because of the deflation, which will crash the economy, which will crash the GDP, which will admit as a recession by the government, which why the stock market gonna, blow up like hell. But that's the danger for this market sector. So as I told you, if everything turns positive on the commodity market, in average, then just take separately what is essential right now, and essential in terms of where is the need, and the need is store value, and that's what we can start planning with longer term, a little bit depending on the technical charts as well. But yeah, the environment gives us the opportunity right now, and while other sectors probably could go up, could be good, but for shorter term, and that's important. Okay, I think that was a very useful information. I hope it was a useful information for you. The Forex market, the overall Forex market point is going up drastically. That's at minus 12 points right now. And that's because, yes, you believe or not, but most of the currencies are not in bull trend yet. I'm going to show you the charts. So they are negative, but they're moving to the upside. In fact, they're very close to breakout, but I'm going to show you that later on. So the point is going up. Very nice. The direction is very mixed because some of them, however, is in bull trend. And the direction status right now is that we are returning back to breaking points to the upside. It's very interesting time. And so the power of these trends are coming from news, sentiment, and technicals. And that is the problem. Because what's missing here? The macro and the geopoliticals. Now, can you imagine a Forex market driven by retards? Because I am not. So therefore, we need to be very careful, because macro and geopolitics are supporting bull trend, not bear trend. And so, whoa, that's just, bull trend for the DXY. And so, yeah, that's really, really something that is alarming. So that means I do not trust in the direction currently what I'm seeing on non-DXY indexes, apart from a couple of them, and that's especially the Japanese yen, but I don't see the bull trend in Japanese yen anyway, so that's not a discussion point. So the risky sector is the strongly moving indexes without breakout. So every single index which is moving to the upside very strongly, but did not make a breakout just yet, is very risky. And the main sector is the main risk to the Forex market is the financial downturn, because geopolitics and especially macro is in the surprise possibility group and not the sensitivity group. So currently the macro does not support the trend and therefore could have the biggest surprise ever on the forex market. So that, be careful with that. But other than that, technical charts will decide about everything. So crypto market, a stock market overall one, sorry. So it's going up, building up, minus 40. Oh, by the way, we just saw that. So then the crypto market is coming up. There is a slight increase in overall point, as you can see. But again, that's what a little bit worries me, because I see that we are not able to increase, accelerating on an accelerating pace. And therefore, that's just too slow for me, which maybe signals to us that the resistance what we found is maybe too strong. So let's just we need to focusing on definitely on the technical charts, because the market. Oh, sorry, that's always just playing around with me. So the main trend in the market is bullish. The main direction status is that assets are in consolidation, even in longer consolidations. But the sensitivity of the trend is coming from geopolitics, news, and sentiment. All three, which is very important to the crypto market. So we can't say that this is a stupid rally to the upside. This is a very well supported rally to the upside. But the surprise could come from the macro, which is always could come from the macro in terms of the money supply. I explained that for many, many times. Technicals, obviously, because if there is more trader entering the crypto market, then they're going to focusing on technicals. They could cause some troubles, that's obvious. And the news, because the news is something really driving the sentiment on the crypto market still, so that could cause surprise. The risky sector, there is no particularly risky sector in the crypto market, which is so unusual for me to say that, but compared to other market sectors, that's obviously that's the truth. Only the general risk of crypto market, which we know, all of them. But the main risk for the market is technicals and financial downturn, suppressing further money supply, fiat money supply, because without fiat, the crypto is not existing. So that's the overall fundamental state of the market right now. And for those who are staying with us in the second half of the live stream, I'm going to show you a couple of technical charts